Okay, very good morning to everyone. It's Thursday, 21st of December, so I hope everyone is well. Just going straight into the briefing then, and an overview of what we're going to cover. A few things to have a look at. The close on Wall Street yesterday saw a second day of some weakness from these elevated all-time high levels in US equities as the tax bill kind of situation is almost done and dusted. Just what remains now is the official sign-off from Trump, which looks like it's going to come in the new year, but ultimately he's managed to get this over the line in time for Christmas, as he had promised. We'll have a quick look at some of the sector rotation outlooks that a lot of the big banks are looking at to potentially continue. So we'll look at that. We'll also look at Theresa May. There's been another senior cabinet resignation, or I should say a firing rather than a resignation, last night, and does it have any impact on the market? And then we've got the Catalan election, which is currently underway, and then we'll have a quick review of the economic calendar for today. So first off then, let's have a look at the situation as it stands, so to speak, for the charts this morning. And just while I'm talking, I do want to keep an eye on this DAX index. Euro's at session highs, and there's been a pretty good inverse relationship here. Euro strength, DAX weakness, which we typically see, just the consequence of the impact then on the export names within Germany in particular. But the DAX index is trading precariously close to the 13,000 level, which is also that support point from mid-month, 14th and 15th. It got tested a few times but did hold before then the bigger ramp that happened on the positive developments that came really at the end of last week, that it looked like then the market started to price in the tax bill going through. The fact that it has now, largely explains a lot of this profit taking as we go into year end really in the Christmas season. So just while I'm talking, I am mindful of as a key level we're just above at the moment. So just keep an eye on that, because if it does break, the likelihood is we'll probably get a pretty aggressive and quick extension on the downside and a fast money move. Otherwise, the close on Wall Street was, you look at these charts and you think, wow, it was a pretty negative day overall in the US. We obviously had that big move lower at the open. What has been interesting, of course, is that we've had 2 days now back to back where post the completion of the tax deal, we've had quite big sell-offs at around the open. Now, the interesting thing was 2 days ago, we then rallied and we closed back to reverse pretty much the entire move. However, yesterday we did remain largely lower, albeit, to put it into context, the S&P finished down just 0.08%. So, this isn't by any means a catastrophe for the market and a big correction or sell-off or anything of that nature. It probably just feels that way when you're in the midst of it around the open, because market conditions generally at this time of year are particularly light, and therefore if liquidity is pretty thin, you tend to get these fairly exaggerated moves, particularly around the market open, where then that's the flush of orders that comes in. So if we get a repeat situation, obviously keeping an eye on the low point that we printed shortly after the open yesterday in the S&P. I guess the more interesting level though in the SPUs, if we continue to move lower, comes down really at this area, if we should get down to that point, because this level of 26.75.5, that obviously is the resistance point on the 13th. You can see then that on the break was really the catalyst for the catapult higher. Did come back to around that level before the push. So when it comes down here, it's going to be interesting to see how it reacts. Just given the fact that I still feel the market should be relatively well supported, although I think this profit taking from all-time highs up here is understandable. I do think though that here could be a decent buying opportunity in terms of buying the dip in that sense. So something to just look out for. Otherwise, the other charts you can see here, the US 10-year is pretty flat overall, not too much movement. But it has then, of course, I think Piers was talking about this yesterday when he was talking about this quite distinct move that we've had in yields in the context of the week. And Bunds obviously breaking some key levels earlier in the week as well. It's kind of confirmation of the tax deal going through. You've kind of got a more administration-friendly Federal Reserve under Jerome Powell to kick off from February. Does this then lead to a more aggressive policy tightening as we go through into 2018 is the question. This obviously comes also in the context of good data this week that we've had, and good data overall, I guess, from a global perspective in terms of economic improvement. Probably, as we'll see in a second, it's only the UK which is probably bucking that trend slightly at the moment under the Brexit cloud. But in the major pairs, just having a look here, top left, let's have a look at the pound. And one of the things here I was looking at was a little bit longer time frame here. So really I'm looking at a range that we've traded for much of December. We were looking before at this trend line going here, and I know a few of you were looking at this yesterday at the time, and I know that this point here, that was yesterday's respective R1, and then it was a pretty good setup for the entry point at that level, with the stop then at the previous high on the 18th. I know quite a few of the guys here traded that. Appropriate then risk managing of that trade, following the trend of just generally lower highs. The fact that the range in itself is getting more narrow, and then managing to play and stay in that short down to pivot, and then following it through all the way down. So, really excellent trade from a couple of you yesterday on that regard. The one interesting thing here is obviously that as we've gone through this week, the range here is getting smaller, which I think is understandable. We kind of go into what usually on Friday before the Christmas break is particularly quiet. So I would be looking at these ranges here, particularly on the upside. I guess if we get back up to that R1 again, you could have a repeat situation as similar to yesterday. The short around the R1 with the stop then at the previous day's high. So repeating the same trade or strategy, but with a slightly different price point in terms of entry and execution around it. Now, from sterling news, we have had some. And Theresa May, another casualty of the cabinet. This time it was Damien Green, who's kind of seen as the deputy, if you like, within the cabinet, and he's been caught out with some porcupines he was telling around his use of pornography 10 years ago, basically, and so he's been fired on the back of that. Now, you would think that this probably then adds to disruption to the Brexit process, given this is, I think, third senior cabinet member so far in recent months that we've had either resign or get fired. But ultimately, I don't really think this is a market-moving event. I think if this happened a few weeks ago when Theresa May was really under pressure, I mean, that point was really the beginning of October, if you remember the coughing fit when she couldn't speak at the Conservative Party conference. I think if this sort of stuff was happening then, it would have been a lot more troubling. But the fact she's managed to get this first phase of Brexit over the line, I would say that's probably then what's leading to this fairly calm response in the market, and it certainly isn't influencing the pound this morning in that respect. So overall, there's an update there for the cabinet, but really it's not a market-moving thing, and something I don't think you need to really consider in terms of intraday strategies for today at least. So that's the pound story. If we have a look at a few other things that have occurred from overnight, we have had the Bank of Japan, probably the most boring central bank out there at the moment, because they are just nowhere near any type of policy change. So unlike the Fed, for example, who are at their most change, if you like, the change of leadership, the change of potential ramification of the tax deal and other different policies that might come in 2018, like infrastructure spending, like regulation changes and so on and so forth. It's the Fed that are probably the most interesting going into 2018. The Bank of Japan, though, are keeping things very steady, signalling last night that they're in no rush to edge away from their crisis mode stimulus. I mean, inflation in Japan is still well away from that 2% target, so no real change, and actually no real movement in the yen the yen move has been more just a byproduct of a continuation of a trend that we've had really materialized throughout this week. But in dollar yen overall though, we are coming up to a fairly interesting level. You got this R1 which we've tested so far this morning. You can see that was the previous highs that we had back at the beginning of the month. Did get just above there before then a pretty decent move lower seen mid-month. So a point of significant resistance just being tested this morning, which is more, not so much a reaction I'd say to the Bank of Japan, but more just a continuation of the trend. The Bank of Japan is quite unsurprising in terms of what they've done ultimately. Looking here on a slightly longer dated time frame, this is obviously the level which we were just looking at, but looking at a broader context to, if we were to break here, so where would we be looking next? So this is where the key points at the moment, which is basically the 113 handle. Any push above here, then it will start looking up towards the December high. That was 113.73 before there. So interesting technical level, but it'll be interesting to see whether that can hold, because it would be going against the trend that's been materializing. And obviously the correlation mix has been equity weakness has been very much isolated really to that asset in terms of this US equity weakness at the open, because the yen's been pretty unresponsive from a risk point of view. So that correlation has broken down a little bit of late. Talking of the equity market, Piers and I will be doing a chat later this afternoon where we're going to have a bit of an interview style where I'll be talking to him about his thoughts for 2018, and we'll discuss kind of our outlook for things like Brexit, the Fed, global inflation, so on and so forth. So I'll have that ready and hopefully out to you later today. But one thing I wanted to quickly touch upon, because the headline I saw in Bloomberg was the outlook for tech stocks. Because the reason why I want to look at this is because look at the tech stock performance here. This is the year to date, and it's pretty incredible really what these, particularly the so-called FANG stocks, have been able to do this year. Looking at this chart, I think this is a percentage change, and we're looking at just an incredible rise here, and particularly when the tax bill really started to make some headway, which was coming in, I guess, the commencement of Q4, but really phenomenal returns. We've had a little bit of a pullback. You remember at the beginning of this month, everyone was talking about this sector rotation. Now that the sector, which has been largely quite overbought in some sense, and this generally is a theme that most of the banks are anticipating going into 2018. So after 4 consecutive years of outperformance, tech companies are facing mounting concerns about the potential for increased government regulation and this continued rotation play by investors into higher taxed industries as a result of US tax reform. So they don't think that tech stocks by any means are going to decline. They just think that the better performance and return will come from other places. So, I mean, JP Morgan here summarize it, I think, pretty much. Fundamental drivers for tech stocks remain intact, with significant stronger organic growth compared to the S&P, but the sector faces headwinds from tax-driven rotations out of growth and into value. It's the bottom dollar there with that play. Certainly as well, although it has been priced in to some extent, the other thing to watch will be, obviously, as I said, not only which sectors will benefit the most on the tax change, but also, I guess, where does Trump go next with what policy? If it's infrastructure spending, well then usually if it's making America great, then it's more demand for domestic level stocks. You might see some decent movement in smaller market cap US stocks like the Russell 2000 index, which is more representative of that national kind of representation. Or you might then get, if it's a regulational change and we're looking at watering down significantly financial rules, that's going to be highly beneficial for the financial sector. So there's still a lot of things to look out for on that front, but we'll talk about that more later. 2 more news articles, then we'll wrap things up. This is the other major thing which is actually occurring. It's kind of gone a little bit under the radar, which I think kind of suggests that we're not expecting an outright, by any means a game-changing decision today. It's likely to be quite messy and end in just further political talks, potentially talking about coalitions and so on. But this is the Catalan election. And again, not a lot of people talking about it, which I think kind of reflects the market's calmness about this situation. So the euro and so on is not really seeing much reaction, but it's definitely something I'd be keeping an eye on later when we start to get some indication of results and turnouts and so on. So the Catalans going to the polls in a regional election that could determine whether separatists push ahead with their drive for independence or look to settle their grievances through negotiations with Europe. The polls have been incredibly close, actually, and this is what's made it a little bit difficult for trying to find out what exactly the outcome of this will be. But the two most likely scenarios are either fresh majority for the three pro-independence party or a hung parliament. Either way, a period of tense coalition talks are set to follow, and as such, then, generally speaking, that's why we're not going to get a firm, concrete answer probably as soon as today. It's going to be weeks before this really gets resolved. Same case as well with Germany. Your update on that is that really these talks are going to, I read this morning, I think the SPD and Merkel's CDU-CSU party are going to recommence their talks on the 7th of January, aiming to then get a deal done around the 12th of January. So everything's kind of been pushed onto the back burner for the Christmas and New Year period. This was just one other headline. I don't know if you guys have felt the same, but we had a dinner, me and the Amplify team, on Wednesday night, and also having done a bit of shopping as well, Christmas shopping the weekend before. I've just found the high street incredibly quiet, like comparative to Oxford Circus and a normal Christmas period a few days before. It's probably me and every other husband and boyfriend frantically running around trying to find that last minute gift for our partners. But it was just very quiet, and the recent data would suggest that there is this impact of which this kind of wage squeeze, if you like, or household income squeeze because of stagnant wages, in context of just this is going to be one of the more expensive Christmases we've had in a while from a cost perspective, given inflation is at the levels we've not seen in several years. And so British consumer sentiment, as measured by the GfK overnight, has fallen to its lowest level in 4 years this month. So again, inflation squeezed households getting more gloomy about their view of personal finances. They said in their data this Britain's departure from the EU, coupled with the Bank of England's first interest rate rise in a decade, weighing on consumers who felt their personal financial situations had worsened and they're less keen to make big purchases. So I'm going to be really interested to see when the UK retail sales data comes out for the Christmas period, which obviously is key from a seasonal point of view. I just have a feeling that it's going to be pretty weak, which certainly has been the trend. But a lot of this, I do also wonder how much of this is just a consumer behavioural change, where Black Friday and online shopping and purchasing is just becoming more prevalent in terms of spending behaviour. So it's going to be interesting either way. Okay, quick look at the calendar for this morning, and it's pretty quiet for the morning. You only have UK public finance data, but ultimately this is non-market moving. I certainly would keep an ear out for it, but I wouldn't be looking to action much on the back of it. Very seldom does it have that kind of immediate impact. So looking at that range that I was saying in cable could be the more interesting play. Going into the afternoon, we've got US GDP, so let's have a quick look at that. Now, one thing to keep in mind, first and foremost, this is the final reading of third quarter growth for the US, so certainly are not expecting much here. Generally speaking, between the advanced, the preliminary, and the final, it's kind of just a refinement of the data, and therefore revisions get ever increasingly smaller, and this being the third and final version of that GDP growth. So at this point then, I'd be aware of this when it comes out, but I'm not expecting too much just for the growth number to be really finalised at around these levels. So if you remember, it did get revised higher when we had the preliminary reading to 3.3%, which was a pretty substantial upgrade on the 3% in the advanced reading, and it was above expectations at the time. Going back to the calendar, you do also have the kind of main cluster of the data certainly is at 1:30. So finishing off from a US perspective, you've got the weekly jobless claims, and you've also got Philly Fed. So this is what Philly Fed Manufacturing Index, the headline, looks like. In terms of an expectation, we're expecting a fairly similar reading to what we had previously, so 21.5 is what's expected. And certainly in the context of the year, it is a bit lower, but if you're putting it in comparison to how the last several years have performed, this is at the upper end of the spectrum in terms of the economic data. And so for that reason, although the last print was the lowest since August, I'm not really expecting this to have much of an impact, certainly not from a policy perspective at this point. So everything from the US side of things, jobless claims included, is kind of, you need to be just aware of it, but is it going to cause this market reaction? Probably not. And what has been more prevalent is I think a lot of people are just looking to the equity market at the moment as a bit of a pre-indicator to market sentiment, particularly given the weakness of some of the correlations. What has been the theme has been when equity markets open at 2:30 on the New York Stock Exchange, we've seen that weakness. And I think people will be looking to that open again to dictate kind of proceedings, so to speak. One thing though for the guys at home, the live traders, I know some of you do look at the Canadian currency, you've got CPI and retail sales. Now if I remember rightly, last month when this came out, we saw a big move in the market. The CAD currency does tend to be highly sensitive to this kind of more higher ranking economic data from the country. So definitely loonie specific, but if you are looking at that and trading that, some of the guys at home, then definitely I'll be aware of that later on. That will come alongside the US data. And then that's pretty much it. There's a few other things in the afternoon, but again, nothing of much significance. The consumer confidence reading for Europe at 3, again, it's probably unlikely to move the currency too much. So overall, I would say be mindful of the fact that things are likely to start to get increasingly more quiet, particularly as we go into tomorrow. So accordingly, looking at identifying strong technical trends and areas of strong support and resistance, and being realistic with targets is probably the best approach in a day like today. Keeping an eye on the open on Wall Street, as I said, that tends to be typically where the best of the more sizable market moves have come. I am mindful of watching the DAX at that key level in the futures at that 13,000, and then sterling cable on that level we discussed. Fixed income markets doesn't look like they're going to change the trend, of which definitely has been enforced throughout the week. So the bias there would still be looking to short at decent technical points on any pullback higher to want to get short again at this point. I think that's irrespective of some of the equity move, which although we've had sell-offs, generally speaking either gets reversed or is contained. And despite the initial flurry at the open, it normally gets mitigated. So it would make me feel more assured that the trend in the fixed income markets lower would continue. Okay guys, that's it. So have a good day. Any questions will be in the chat room as per normal. Thank you very much.